run into their furnace, right? They've got, like that Camaro, I don't know, it was like $100,000 almost for this new. I'm like, why didn't you just buy the Corvette, you know, but,
Wow.
yeah, I don't know what it's called, like, he's a car, I'm not a car guy, so, he definitely is. That was his toy. He's got a Tesla S, the one with the ludicrous mode on it, right?
What does that do?
What does that do?
Yeah.
It goes like 0 to 60 in
The
about
fastest
2
production
seconds,
car
3
ever.
seconds or something ridiculous,
Yeah, it does.
right? So, all right, so today, I want to start out by kind of seeing where you guys are in, at the end of the week here. So, bring me up to speed. Where are you guys right now? What did you guys cover yesterday?
We covered the roof,
So product information.
yes.
We're gonna cover like financing.
We are,
like-
yes, for sure. I just want to know where you are.
So we covered phase one, and then we covered the roof. And that's great. Well, we covered a little bit of closing yesterday as well.
You did?
Yeah.
Okay. So what I want to lead you up to is kind of like some of the pieces to get to the actual close through your finance meetings, right? So how can people pay for products? Right. First and foremost, we have good old cash, right? And then you have, we'll call it cash or credit. They can use a credit card if they wanted to. We'll take it. I don't necessarily recommend it unless, you know.
They're rich.
Well, yeah, their interest on that is, I mean, the average, if you're saying most people versus some people can do it because their interest on their cards are low, but I think, I don't know, the average rate on a credit card is what, 9 or, I mean, it's probably going up. I don't know, for even good credit customers. So cash or credit, and then you've got unsecured. And then we'll consider PACE a separate entity from secured, even though PACE is secured. Right? And then you've got one of my favorites. Friends and family. And then, you know, traditional, like refi. I hesitate to put reverse mortgage, but some people, right? So, if you sell something and somebody wants to pay cash, you need to kind of be able to explain to them, they're gonna say, well, how do I pay you, right? So, if you take cash, it is $1,000 while you're there, maximum, okay? But if you sold a project for $9,000, you can't take $1,000, you can only take 10% up to 1,000, okay? 10% of the sale, up to 1,000 max, okay, on a cash deal. This is in-home transaction, right? If you don't take any money from them, you really don't have a cash transaction. You've got a wishful contract. There's no skin in the game from them. You really don't have a deal. I'd be very concerned if I were trying to start a project with no money, right? We typically, and this is just a guideline, because, hey Mike, good morning. It's gonna change by product slightly, but typically what we're gonna do is 50% at the start, okay? 30%, which is a progress payment, usually material delivery or at some agreed upon point during the process, right? And then upon completion, we don't wanna have, 20% would be the balance, but that's really that's the max we'd wanna leave out there on a cash deal, because it's, they've invested with us, and there's still a lot of number. That's basically the way it works, right? When you do this, Mike, when we're, you split that up a little bit different, is that? Okay. So, cash or credit, whatever they're doing, Cash or credit card, same thing, right? Cash, check, however you wanna look at it. How many of those do we do? Not many, right? This is probably 1 to 2% of our business. Right? I have one cash deal active right now. That's it. Unsecured. This is a big group of items. And I don't wanna get you guys worried about having, this is not for you to remember all the little pieces, alright? This is to give you the overall scope of things. I'm gonna break it down into some of the options, but I don't expect you to be selling the financing to the homeowner. What I expect you to be doing is finding out what their buying signals are, how they wanna buy, how they bought in the past, and what makes sense to them, and know that you probably have an option that fits that within the unsecured realm, alright? So a cash customer, is a little bit risky, right? They're holding cash, right? If we get something secured with an unsecured financing, I hate to use that secured term, you know, what you have here is same as cash, up to 24 months. Okay, that's one option. So I wanna stop right here and just say what you see here, cash, and then same as cash up to 24 months is about 80% of general contractors what they offer. Take a look at that. That's it. What's the interest rate on a same as cash program? Zero. Except for when they get their paperwork, it's gonna show them something like 17.99% on their paperwork, right? So this is the only thing I'm gonna tell you. When you do this stuff, if you do it, their paperwork is gonna say 17.99% because that's the default rate. If they don't pay it within 24 months, that's the only thing, all right? What you need to remember is there's an option here, same as cash. I don't wanna get into how that works specifically, but just understand if they don't pay it within that, whatever that time frame is, there's gonna be interest accrued for the whole time and they're gonna have to pay for it, right? So then there's also something called equal payments, EPN. Okay? This just takes 5 years, takes 60 months, up to that. Whatever the dollar amount, you sold $30,000 divided by 60, it's $500 a month, they pay that every month, they pay that, and if they continue to pay that and they don't miss a payment, there's no interest. Okay?
What is EPN?
Equal payments, no interest. Morning. Are you here for an interview or you?
Yes, sir.
Okay. I like this program. I like it a lot. And what it allows you to do is to give a cash buyer a finance option that they probably love because it's flexibility. Right? So they don't have to take all their money out of whatever investment they have. They're not paying any interest on this, so, you know, keep that money earning somewhere else.
That one probably, they have to have good credit, I imagine.
Yeah, these are, look, this is credit-based.
Yeah.
Okay? These are unsecured, are credit-based products. Okay?
Is there early payment penalty with any of those two?
No prepayment penalties on any of our loans. Okay? So, and then you've got traditional stuff that goes from 2.99%, actually 2.79%, all the way up to, let's say 15% or so. Okay? So you asked about credit, these are credit-based. An excellent credit customer can get a standard, let's say, I don't know, 7 or 10-year loan up to maybe 20 years. Okay? So those are the unsecured terms. You're gonna have a much higher payment than you would on a 20-year because that's the on a 25-year or 30-year because only one program goes to 20, just one. Great credit, good income, everything verified. You're not gonna hit it very often, okay? But, you know, this is the thing you have to look at. you have to be prepared that one of your customers has really poor credit, they have no equity in their home, and they're gonna end up getting something 10, 11, 12, 13, up to 15% on a 10-year max term because they have poor credit. So, and the reason I'm bringing this up is because we're gonna talk in a few minutes about presenting the financing options, and you don't wanna pigeonhole yourself into something, you know, Vasile said it earlier, as low as, right? That's an important phrase, right? Depending on your credit, we have options as low as 0%, right? So, it's credit-based, and any questions on this piece? I don't wanna get, again, I don't wanna go into all the details, but go ahead.
Could you mention again what EPMI is?
Sir. It's equal,
I mean,
what it stands for?
no, not what it stands for, but how does that work?
So, so you've got terms, you know, from 2 years to 5 years, okay? So just as the example I used was a 5-year term. So if you have a $30,000 project over a 5-year term, that's 60 equal payments with no interest. It's just 30 divided by 60, it's $500 a month, okay? That's it.
So short-term loan with no interest.
That's it, right? So again, I bring this up because what do other construction companies have? Cash or this, basically cash plus, you know, almost cash, same as cash. So you have more options, but again, here's what's gonna happen when you need financing, right? We're gonna help you figure it all out. So if you're with a client and you're trying to figure out how to best serve them, pick up the phone and call. And say, you know, let's get my finance manager on the phone and see what options we have, okay? And we'll go through all the numbers with them. So we're good, we have a lot of unsecured options. I have, right now, I think we have 17 lenders. I use about 5 of the best on a daily basis, okay? So you don't have to know all the 17 terms, you don't have to know anything about them except for, we have more options than anybody. You're in the best industry with the best products from the best company that has financing for almost any customer. I mean, that's what you should be taking to this point, and now we're gonna talk about the rest, okay? PACE is a secured option. What does PACE stand for? Not you, Sean.
Assess clean energy.
All right, property assessed clean energy. Does everyone know that? Has everyone heard that? All right, so I'll write it down here. Property. This changed our entire industry. PACE financing started about 8 years ago and kind of slowly built up. In the last 5 or 6 years, it's really become very dominant. It's maybe split between unsecured and cash across the industry. But what it's done is allowed the average homeowner, middle-class Californian, who wants energy-efficient products, the ability to use their home and their property tax base in order to finance these products. So this is equity-based. So 15% equity in their home is the max that they'll lend. 10% is what they really have to have in order to be qualifying. They have to have some equity in the house. So $500,000 house can, you know, get potentially up to $75,000 depending on what equity they have. Now, if someone with marginal credit went to their credit union or their bank and tried to get a loan on their credit for $75,000, how many of average America, middle class America, do you think would be successful in getting $75,000? It's a small number, you know? It's a It's a small number, because there's a lot of traditional underwriting features that have to go into the other products, okay? This does have some of those as well, but it's primarily equity-based. They have to be able to provide proof of income. They have to be able to show that we're not putting them in a financially strapped position, meaning those numbers just have to show they can afford to pay all their current debts, plus some living expenses, plus whatever the assessment is for payment on this, and then there's like a tolerance level, right? But just understand, that primarily this is equity-based. This is where most of your customers are actually going to be. And the overall approval ratings for PACE is around 53, 54, 55%, depending on the company, okay? So right away, half the people that you're going to are approved. And that's an amazing thing, just to walk in, because previously you had to really wonder, you know, is this person with the 620, are we gonna be able to find a program that allows them to find something affordable? Because this doesn't get them approved, it gets them approved at a payment that's affordable. And yes, they're buying our company, yes, they're buying from you, they're buying the products, they're getting the warranties, all the things that go into making this a really great value. But if the payment's not affordable, what if they can't do it, right? So, everyone, if you haven't memorized that, you know, I would recommend, this talks about tiny, affordable monthly payments in the center of this. That's what we're trying to hope that every single customer has the opportunity to have, because people are buying the payment, right?
Was PACE a government, made by the government, or?
No. PACE is a private-public partnership. None of the money's coming from the government, it's all private lenders. The partnership is the ability to use the property tax assessment for the financing. That's where the municipality has to approve that. So, as you're, working here and figuring this out, there are certain municipalities like, and this is, here's a sales tool for you, right? I'm gonna say, I do this every time I talk about it, because it just, right, Bakersfield. Anyone been to Bakersfield? I mean, that is a middle-class town, right? There are some rich areas and there's some poor areas, but primarily it's your average middle-class California town, right? Perfect for PACE. And one day, everybody in Bakersfield had the opportunity to use PACE. And then the next day they didn't, because the municipality decided, we're not gonna do the program anymore. Too much red tape or whatever they had to deal with. They changed their mind. All of Bakersfield is excluded from using PACE, and there are other municipalities that can't use it either. Okay? So if you wanna have some sort of urgency when you're speaking to someone, it is absolutely imperative that you have some urgency. And when you say something like, look, these programs won't always be available, they may end tomorrow. I can talk to you about Bakersfield. Right? We didn't know that was gonna happen. One day everyone's trying to work out financing to get energy efficient home improvements, and the next day they couldn't afford to do it because the PACE program is gone. So take advantage of it while it's here.
What are the interest rates on PACE and the terms?
Well, it's a good question. I'm glad you asked. But I'm not gonna go into all the interest rates. I'm gonna show you just two. Okay? So, first of all, the originator of the PACE programs, the first program to actually work, named themselves CalFirst, because they were first, right? It's also known as Renew Financial. And then you have Hero, also known as Renovate America. Synonymous, these names, they just rebranded themselves, okay? And you have PACE funding. Which is confusing when I'm talking about it sometimes, because I'll just leave off the funding part, be talking about PACE. But if I'm talking about a finance company specifically and saying PACE, I'm probably talking about PACE funding, okay? And then there are others. E3, Y Green, So, the average starting rate for a PACE program in the industry, right, is, they have 5, 10, 15, 20, 25-year terms. The average across all those terms is around 8% plus about a 5% origination fee or more, okay? Don't worry about that part. We're talking about rates. I was about to explain the whole thing, and I'm not gonna do that. So, 8% interest rate. That's about the average. So, if construction company that is, let's say, they're better than Chuck in a truck, they're better than Joe's construction company that has some financing, and they're probably most common larger construction companies, home improvement companies, have some of this, but their interest rates average around 8%. For us,
Excuse me.
I'm gonna just give you some, these are the terms, right? 2.99 for 5 and 10 years. Okay? 3.99 for 15 years, 4.99 for 20, and 5.49 for a 25-year term. And I did this last time, so, you know, Sean, you can help me out. What is the going rate on a 30-year fixed mortgage roughly?
5.125.
Okay. 5.125. That's a 30-year fixed today. So think about that. We, on the average, they're about 8%. On the average, we're right in around here, 4%, 4.5%. We're half. You are working at a company that allows you to offer interest rates on the same program at half the interest rate of other companies. No one stood up and applauded.
How is that possible?
You're welcome. Because we're in a position, yeah, here's the answer, but, over several months, we have positioned ourselves with the finance companies and negotiated with them in order to get these rates. These can change. They probably will change as the market changes, right? As the prime rate, as investor funding to these programs, which are private. Remember, they're private lenders, right? So there's a whole banking, venture capital, investment, you know, there's a lot of things that go into getting that number. But right now, that's ridiculous. Remember, equity-based, not necessarily credit-based. A 25-year, that's almost the same as a 30-year fixed mortgage, right? What's the minimum FICO on a traditional FICO right now? I mean, a traditional 30-year fixed on, to get a rate that's base, it's probably 680. Yeah. Probably, right?
To get to 5.125, probably higher.
Probably higher.
Probably 720,
Maybe even higher.
yeah.
So they're gonna have a 720 FICO, they probably have to have 12 months reserves, they have to have a debt, look, I'm sorry, I'm throwing you again, but their debt to income ratios have to be, you know, no more than what, 35, 36% on these traditional. Remember what I said? They just have to have enough payment to cover their costs and make the payment for the assessment plus $1, basically. Right? And you're getting a rate like that. So, again, I'm gonna say this maybe 2 or 3 more times. This is what everyone pays. This is what everyone that if you go to a house and someone says, I just had an estimate yesterday, fantastic. I'm so excited that you said that. Because you're gonna kill them. You're gonna kill that previous estimate. Because we have this. You have a company with what's our rating on, was it 4.7 stars?
No.
Do you know what the industry average is for a construction company?
25.
2.5, it's in that range.
Rating 4.7 where?
Yahoo, Google,
Google.
Okay.
Facebook,
Okay.
I'll
Everywhere.
across all social platforms. So, I mean, I'm not trying to build this up and say, you know, that customers are payment buyers only. But that's their primary focus. They're thinking, if I can afford what you're offering, you're so much better than that company I looked up yesterday. You are so much better at the product, and the warranties are better, and I like you. So if you can just make it affordable,
Well, in essence, because of the interest rate you're paying, it could even be, lower than the other guy's paying.
yeah, for a lesser product with a lesser warranty from a lesser company, a better payment. I mean, just go, yeah, can we give them all an appointment? Because everyone should be excited to go sell something right now. Right? All right, so. We also, don't wanna confuse you with the idea that you have to do all this by yourself again. What was my comment a minute ago? When you're doing financing, if you have a question, call the office. You can call directly to some of the PACE reps if you want as well. Grayson is, someone that's gonna talk to you guys from PACE Funding. He's very responsive. He really loves to be involved with, every deal. We were with him yesterday, and all of a sudden something came on his phone. He picked up the phone, he called them, he's like, yeah, we can do this and find this proof of income, and then we're good, right? So he's getting a deal done right then. He's involved in every transaction pops up on his phone, and and likewise here, so. Friends and family. Why do I put this on here? In this spot, before this spot. Okay? So, with PACE, the only people that can borrow, the only people that can help you qualify have to be on title. Okay? Right now, as of today, there can be contributing income from people that live in the house if they're not on title, but I believe in January that might change, right? So let's just consider this, they have to be on title. These people, most of the time, have to be on title as well, but you can have a co-borrower, okay? So if they get declined, remember, if they get declined on a PACE program, and this is where we typically start, because of the rate. I mean, if you look at the interest rates, and this is between, 2.79 to 15%, but someone with a 500 FICO score is gonna be, if they get approved at all anywhere, is gonna be, 15% interest rate on a 10-year max term. Where this guy with a 500, if he has a little bit of equity, could be on a 15-year at 3.99. Because it's not credit-based. What a huge difference, right? But sometimes people don't qualify. They get declined on these programs, and maybe they got declined on one of these, because they have poor credit. If they have somebody that has good credit, friend, family, I don't care, if their neighbor is really good friends with them and they wanna co-sign with them, they can do it, okay? So friends and family is an option when you have a decline. It's not always gonna work, but if you just say, hey, obviously this is really important, you have a need, your roof is leaking, we're trying to solve that problem for you, you need to get this done right away. Is there someone, either a friend or a family that you know that you've either done a favor for, or that you guys are really close, or you go to church with, or whatever it is, that can co-sign, or be on the application. Don't leave that out. If your choice is between asking that question and leaving the house with nothing, why wouldn't you ask that question? And there's no response, right? So I'm guessing everyone understands that that should be happening every time if you have decline. Look, you're there to help them.
Dr. Friends and Family works with PACE?
No,
No. This is
that's what I was saying. Anybody on this program has to be on title.
Right.
Anyone that's on the application has to be on title, okay? With unsecured, you can have a friends and family apply, okay? I mean, in worst case scenario, they may have like a family member that is in really good financial shape, that they're gonna leave the house to anyway. Maybe they have a son that they're gonna leave the house to anyway, and one option would be to quit claim, add them on title. So then they would have to be in that, yeah.
I know PACE style requires proof of income. Does unsecured financing require proof of
They
income
do.
always too?
Not always, not always. But let's just say yes. because those circumstances you're rarely gonna come across where they don't require it. What'll happen is we'll get an approval, and then we'll look at the stipulations, and I'll tell you whether or not you need to get it. It's a good question. What was your name?
Jackson?
Jackson, all right, so, there's a few things that we'll go through as far as what's required for each one of these to get approval. I'm just kind of going through the scope, and I'll dive in a little bit more, as we go through this. So, friends and family, ask. All right? It's the same terms, it's the same things we've talked about, just make sure you ask that question. Okay. So we have a customer right now that has $20,000+ in credit card debt. Their car, the transmission just went out on it, single mom. They don't qualify for PACE, they bought the house a year ago, there's no equity in their home. Their credit is poor. And, like I said, single mom, no one contributing, basically, all those options are gone. So, we just, this week, got her a refinance. And paid off. So there's a program, they were able to get an appraisal with this in order to get enough equity to pay off some of her debt and get the improvement done and lower her monthly payment. So, that's where you go with this. Now, she may be spending, 6.75 or 7.25 or whatever the rate is. Okay, but that's gonna improve her credit, and then 6 months later, she can refi that, and go down. But right now, we're helping her because we're getting some of her debt paid off and her existing loan, which is at a higher interest rate, and cash out to pay for home improvement. So that's your last option. Just in case you guys wondered, we do all this to help people, but you're here to make an income, I'm assuming, right? And, we're here also to make a profit. We're in business. So, this option secures a deal that might not have otherwise happened, but you need to understand that from a cash flow perspective, this could be, 30 days to get an approval, depending on how slowly they come up with all the required documents, right? If they're motivated, they usually come up right away, but really poor credit customers that get to this point because everything else was declined, my experience is they don't know where to find their mortgage statement, let alone, what's in their bank. I mean, they're just not organized. That's part of their problem, right? So it takes some time for them to get all the information together. And then, 45 days, so it could be a couple months.
On a refi, is it if they have poor credit on the other, is that another reason to use a refi, or is it credit based?
Yeah, refi is credit based.
It is credit
For the
based,
most part, but, so here's the way my mortgage guy says it, right? If they have great equity, or they have great credit, one of those two, they can do, if they have both, obviously that's a home run, but if they have one of those two, they can usually find something, right? But you're not doing this typically on a home improvement loan. If they have great credit, you're getting something here because
Right.
if they have great credit, we're gonna get a great interest rate, and they probably can pay it, right? If they have poor credit, and maybe they have equity, like this lady had some equity, but she had a mortgage late. So if they have a mortgage late in the last 6 months, it's not gonna qualify for PACE. So write this down. PACE funding requires no more than one mortgage late in the last 6 months. You can have a bankruptcy as long as it was discharged more than 2 years ago. Right now, all the PACE programs will look back in your credit history if you've had a bankruptcy. Let's say you had a bankruptcy 3 years ago, 4 years ago. They'll look back from that time, and if you have had late payments on consumer credit, auto loans, things of that nature, they can also decline you because of a bankruptcy plus late payments, right? You shouldn't have, once you've done bankruptcy, you shouldn't have late payments, right? It's supposed to restructure your life. If it was 7 years ago, they're not gonna look at that. They only go back 4 years now, okay? The other other most important piece on this, because it's property tax, property assessed, they have to be current on their property taxes, and they can't have been late on them for the last 3 years. That's it, 3 things. Okay. Aside from that, those are the 3 issues that can stop it. So, what do we need when you're in the house, right? We need for every customer, you asked about proof of income earlier, right? The standard practice should be to ask for, I'm gonna do this a little bit different here. Let's start with this. Finance.safecal.info. Okay? Finance.safecal.info is our portal, where you can plug in some information and see several different options on payments that are generally kind of cover a broad base, but there's no interest rates posted. Okay? But on that also, the most important part of that is not necessarily the portal, but there's an application here.
When you say there's no interest rates, are those payments usually gonna be based on the better, and, or do you know what they're based on the scale of the interest rate?
Yeah, so like the 12-year term is based on a 10% interest rate. Okay, just to give you one example. So they're all over the board, it's to give you kind of a good, better, best. All right, if you're using that. My suggestion is not to use that for presenting your payment options, but to use the PACE funding portal. Okay? PACE funding portal has a very nice standard rate that is, in this 8% range, and you can show whatever, start there. And you can show the payment options for whatever term, and kind of get them thinking about what's the range that's really affordable for them. So we'll get to more detail on that as well here. All right, so if you start here, you get to this point by having done your presentation, finding out the need, making sure that there's some urgency associated with what they're doing, presenting SafeCal in a way that shows the value that is inherent in the product. And also, it allows you to, at this point, ask for their business, right? So you're gonna say to somebody, Mike, we've been talking here for a couple hours, hopefully I've answered most of your questions. I kinda wanna do a little summary, and, see if there's anything that I've missed. So with respect to our company, SafeCal, would you say that there's, it's the type of company that you like to do business with, that you see the credibility, you see the history, you see the way we organize ourselves, and it's something. So you're gonna summarize the company piece, right? And you're gonna say, this product, does it fit your need? Obviously, we talked about mold remediation, if you have some problems, we're gonna take care of that. If the HVAC is gonna, whatever the issues were, right? I'm not gonna review the whole presentation here for you, but those things that you've built from your rapport, to your presentation, to your inspection, and now to your pricing, you're going to say, based on all those things, sounds like if I can find affordable payment for you, that we should probably be moving forward with this. Or if I can find affordable payment, would there be any other reason, not to move forward? Or positively, right? You ask them the question. Like I don't wanna, our goal here is to make sure we provide the best products at an affordable payment. So when we're talking about this monthly, I don't wanna take bread off the table. What's a number that would make sense for you on a monthly basis that you can afford? What's the ballpark there?
20,000.
Huh?
20,000.
No, monthly payment.
Oh.
I love you. You and I are gonna talk after, but, someone may say, give me a monthly payment.
$100.
up to,
Up to 150.
up to 150, alright? Whatever they say, always reply up to. Okay? Somebody said, well, no, that's the max, but it's weird. Like 80% of the people will throw $50 on top of it. You know, they'll say 250, you go up to maybe 300, you know? So Jackson, if I can find something that's 200 or less, and you're comfortable with everything we've talked about, you don't have any further questions already, safe to say we could move forward with this.
200 be pushing it, but if you can get under 200.
Under 200,
Yeah.
right. Obviously, the goal is 150, I think that's where you started out. But if we can get it under 200, that would be a reasonable thing for you.
Yeah.
Right. On a scale from 1 to 10, how comfortable are you with the overall process right now?
Let's say a 9.
A 9. So the only question is whether or not it's affordable. And if we find it, a payment that's affordable, would we be at a 10?
Definitely. Have we talked about cost at this point?
Sure.
We've
Yeah.
already gone through price and everything?
Yes.
Okay. Yeah, I think so.
Okay. Now what am I gonna do? Get them financing. So I may show them the PACE funding just to say, why would I show them an interest rate at 8% on a program that we're not even gonna give them, we're gonna give them a much better rate than that.
That way they know the difference between what we're offering and what.
Everything that we're doing, putting booties on when you walk in the door, the inspection, the way that we do it, the mold treatment, all these different things are differentiators, alright? Talking about the warranties, it's a differentiator. Talking about the customer satisfaction ratings, the rating in the industry, the Better Business Bureau, the length of time of business. You don't just bring this up because it's nice to list them, right? One of these items is very important to your homeowner, but you're not sure which one unless you've gone through and kind of asked. You know, of the things I just mentioned, which one is most important to you? It's a great question, right? We just talked about the products, the warranties, the companies in business, the rating, of these things that we just talked about, which one is the most important to you? Well, you know, a lot of people are just gonna say the company. There's a lot of products out there. Right? A lot of people are gonna say the warranties. But once you know what's most important to them, and you can find an affordable payment, you have a path. These questions that you're asking, these tie-down questions, these sort of probing inquiries that you're doing throughout your presentation, they're geared towards differentiating us from everyone else. When someone has a construction company or a salesperson come to their home, there's this barrier, right? They're like, I want you here, I need something, I don't wanna be sold, right? And that's why it's vital that you go in with the right mindset. We talked about that before, right? That's sort of, I'm here to help, you know, I'm here to help the environment, I'm here to help you, I wanna do both, you have a need, that's why we're there. They called us, remember? Right? They reached out from some sort of marketing or referral, whatever. You're there for a reason. All these things put together is going to build up a psychological connection between you and them. One where they say, this guy's told me all the things that I hoped someone would tell me from a company that I didn't think was out there, with a warranty that's better than what I thought it would be. And if they can make this affordable, I think we should, this is what's going on in their head, right? There's a psychological battle. I think I'm probably gonna move forward with this, I'm not really sure, I hope they can do it. I'm like, let me go to work for you on the finance part, you know, let me put the whole, we have a whole team that works behind to try and find this. But in the customer's mind, they've bonded with the whole process, you, the company, the inspection, everything. And there's this hopefulness that you'll see when they answer that question on the 10th. You know, gosh, if you could get me approved in this, it'd be great. And that's a big responsibility to make sure that you're doing every step of this process. Because if you leave something out in the presentation, that may be the most important thing to that customer. You don't know what it is, right? So, it's a long process. Anyone done in-home sales before? You have? Okay. So you know, it could be like, I've been in a house 15 minutes and made a
$500.
Fantastic. Do you think that I went to the next house thinking I was gonna be done in 15 minutes? I was hoping sometimes it'd be done in 15 minutes. You know, but, you know, the reality is it's 2.5 hours to 3 hours of conversation, answering questions, listening, and listening some more, and then listening some more. You know, the more they're speaking, the less you're speaking, the better your sales are gonna be. Right? Ask a couple questions and have interaction. If you're just preaching to someone, they're gonna catch about 20% of it, and after about 15 minutes, they may be catching 10% of it. And you're gonna say something that sparks their interest. Oh, okay, now they're gonna back up to 20. But it's waning if you're just speaking. Like right now, right? I'm just speaking. But if they're talking, and I'll say this, you know, people only believe a little bit of what you say, they believe 100% of what they say. Even if you're being completely honest, they're like, you know, I'm not sure, still, I have to double check that, right? I mean, we live in a fact-check world, right? Everything anybody says is fact-checked. So, they're not gonna go fact-check themselves. So be honest, be upfront, be transparent, but if you're asking questions, my point is they're answering what's important to them, and that's what you're offering them. You're offering them the solution to what their needs are. All right, off tangent, back on this here, so. If you have a customer that's a 10 and they're ready to move forward with financing, you guys haven't seen the finance portals at all, right? Okay. I wanna go through that. Let me just pull it up here. You guys wanna take a couple minute break? It'll take a minute. Any questions about this? I'll answer them while I'm,
Coffee?
sitting down.
About the refinances, about that lady that,
Yeah.
that had debt and, so when they refinance, so she got a new loan for debt and the cost of the new products went into that new loan?
Yeah. Yeah. Let me see, I have the text from.
Thank you.
Alright, so this is, it's just a web. Portal, right, it's not major, it's not fancy, it's not something I would be showing the customer necessarily. But let's just use. By the way, I know I said 2 minutes, but that was a lot faster than I thought it was gonna take on. So we'll put a $30,000, what was our estimate this morning, the monthly savings we were talking about? Look at it. $150?
145, I think.
Yeah. So you can use the example and say, I would never tell a customer how much money they're gonna save. You know? 'Cause I don't know what their usage is gonna be after I leave there. I don't know if they're gonna get like I said, an electric car. I may ask about it, but they may never buy it, right? I don't know if they're gonna have another child. I don't know if, mom's gonna come move in with them. We don't know, right? it's funny because sometimes people get solar and they all of a sudden are like, thank God, I can now just turn the AC on all the time, right? So, yes, they're saving some of that cost, but they're using more electricity, so we don't know the answer to that. It's a very open-ended thing, so, the way that I suggest you talk about this is to ask kind of the obvious question, which is, I don't know if you've noticed, you know, I've owned a house for many, many years, and one thing that happens every month is I get a bill from the utility company. You know, I'd like to know that every month that utility company bill is gonna be the same, but what I've noticed and what you can look at over time is the average rate of increase is about 7%. And, you know, some years it's 2% or 0, they don't change it every year, but they submit, like Southern California Edison a couple years ago submitted their rate increase to the PUC, right, the Public Utilities Commission. And it was like 15 or 16% that they were trying to increase rates. Now, the PUC didn't approve it, but it went up, like 6, 8, 9, whatever the number was, right, I can't remember, but the details are, it's almost like every year, it's like clockwork, you can count on not paying the same rate. It just, the cost, the infrastructure, upkeep, but we just did a solar project in San Francisco area, and Pacific Gas and Electric is requiring a deposit ahead of time for advanced engineering for a solar project. You know what the deposit is paying for? Them to be able to do an analysis on the increased load going into their infrastructure because they're that stressed. That for every customer that's getting any kind of electrical panel upgrade or HVAC installation or anything that's changing their overall load, they have to pay a deposit of $1,500 to do an engineering. That deposit, the engineering takes about 6 months. And if they don't have to do, if it's not increasing the load, they give it back to you. But what do you think, what are the chances they give that money back when you're actually increasing the load, right? I don't know, I thought it was ridiculous that they were making the customer pay for engineering in order to, it's ridiculous. So, if we just take a look at here, back to this question here, if you're spending $400 a month, it's probably gonna go up next year, 3, 4, 5%. If it's 5%, it's 420, and that adds up in 5 years, you know, you're adding another $100 a month, right? It adds up quickly. So, we're talking about projected utility savings if you're spending $400 a month, and we're roughly saying that we're doing, let's say we're doing HVAC like we were talking about earlier. So during the summer months, it's gonna be 35% savings, but you're not gonna get that all year round, so maybe it's gonna average somewhere around 20, 15. What would you say?
All right.
About right? So if it's, let's just call it 10% of $400, okay? Just to be really conservative, and I'll put $40 a month utility savings. Okay? And I talked about the rate of inflation on the cost of energy. You know, the average is around 6 or 7%, but we can be conservative and say, you know, 3, 4, 5%. What, I don't know, what do you think it's gonna go up? You don't think it's gonna go down, do you? Right?
I don't like that.
What do you think it's gonna go up?
6%.
6%? I think that's what most people say when I ask them that question. You know, validate what they've said. So 6%, I'm just gonna put 5. Again, I'd rather be conservative. All right, so now you have some options to look at, okay? So in asking that question of like what's affordable for you, you can even use this as a tool to say, now, you know, I have a lot of customers that want to pay cash. They typically determine that because the interest rates that we have through our company are really low, that it's better for them to use other people's money as opposed to taking their own money out of something to do this. But the ones that are close to cash and want the lowest interest rate, they could afford to do it, but, you know, some of my customers want a 5-year term. Would that be something that's similar to you? You know, how you buy things? Or are you looking for a longer term, so the payment is the lowest? What I found is that most people are somewhere in the middle, right? people wanna get the lowest payment possible, but they don't want it to stretch out as long as, but it depends, right? Depends on you. So if I said to you, for this project, it's $400 a month, would that be affordable for you? Or which one of these programs looks like it might fit into your budget? If you wanna put a number together for them, right, in front. And then you can talk about, let's say they say it's $393, so you might say, well, look, with the $40 a month savings plus 5% utility cost over 12 years, that net is really $340 a month. The payment's still gonna be the $393. This is for, by the way, average to low credit. So we could be a lot better than that, depending on credit. If they're looking for this, if that payment is where they need to be, or if they say, well, 250 is too high, 200 was my max. Okay. Well, what I would say to them is, yeah, 250 is the monthly payment, but with the utility savings over the 20-year term, that's what your net average is for the term, 183. So it's right in the ballpark of where you're comfortable, but we can try and see what we can do with this payment as well. I told you I was gonna try and get you there. This is just for an example, right? But if we have 200 a month, we know we're moving forward. What is this showing someone? It's just showing that there's a net benefit. Again, I only show this because it's gonna pop up when you pull it up and you go to finance.safeco.info. It's not that I expect you to use this in this way. I told you a minute ago, I want you to use the PACE portal. It's a better explanation. It shows everything all like spread out. You can push on different buttons and you show the net impact. It's much more impactful. The reason I wanted to go to this first is when you submit an application on PACE and you're waiting for that approval, it could be 10 or 15 minutes on PACE funding to get an approval. Could be longer. But once you click submit, someone says we're gonna go ahead and do this, and you click, you fill in the information on the PACE portal and apply, and you're waiting for that 10 or 15 minutes, this is where you ask them a couple of quick questions about the qualification pieces we need, right? So, the finance company's gonna ask for a few things while we're waiting for them to get back to us. Let me go ahead and start to compile some of those things so we make it easy for you. So the first thing would be a driver's license. So if I can take a picture of your driver's license, that'd be great, okay? And everyone has a driver's license on them, right? Why do I ask for a driver's license? I don't need a driver's license for PACE. It's the first like, let me give you something. Right? I said yes, if you get me approved, and now I've given you something that kind of solidifies that, right? So ask for a driver's license. You don't need it on PACE, but you do need it on unsecured. So take a picture of it. Make sure you get the whole thing, because we need the issue date, the expiration date, birth date, everything has to be clear. Okay? Have a sheet of paper out while you're doing financing. Write on the top of the sheet of the paper, leave behind for Mr. Jones, or whatever it is, right? Leave with customer. And let them know. I'm writing down some information so I can refer back to it and check that it's correct, but I'm leaving it here with you and I'm making a note on the top of it. This is for you, okay? What are the things that you're gonna put on that? If you're leaving it behind, why would I do that? Social Security number, write it down, okay? Income. Yeah, any kind of financial information or social security information related to what you might ask for financing, write it on a sheet of paper, have it there for you. Because if you submit to PACE funding and get a decline, you're gonna wanna input all that information on this app. And that way you don't have to think about it any further. It goes directly to me, it goes right to the finance team, they'll get started working on the alternate applications. So you really only have to do one in the house through PACE funding or through HERO, through a PACE program is what I'm saying, okay? There's nothing that sucks the air out of the room more than sitting there talking to a customer about, well, listen, Mike, sorry, we got another decline. Let me just apply this place. Oh, we got another decline. 20 minutes later, oh, they said no. That can happen, but we're getting those upstairs, and then we're gonna text you, hey, I need this, or hey, I need that. Yeah.
Question.
So, you submit the application, and then basically they're comfortable with, say, 10-year at 3.99.
Okay.
And then they come to know that they're not qualified, and then the number changes.
Right, which is why that 12-year at 393 is not at 3.99. Okay. If they say they like a term in that range, 12 years at 393, the 10-year rate that 10-year term that I find for them is gonna be probably a lower payment than that. Okay.
Okay.
There's no interest rates on this page for a reason. And the rates that you're showing them on PACE funding are in the 8% range on the standard program, right? What you're gonna do is show them what you can do afterwards by going to the Hero portal or to CalFirst portal, where I've negotiated with those guys directly to get those lower rates. Okay. So you're showing what other people have and what's affordable, and this does kind of the same thing. Okay. This is not my tool for, I'm showing you this, it's just sitting up there, and I know you guys are looking at it, but don't get caught up in this. Let me show you what I wanted to show you in this, and then we'll go into the PACE thing, because I don't wanna get all over the place. You had a question? Chris?
So,
Yeah.
so you actually go through the application process through PACE,
Through a
on
PACE
their
program.
PACE portal,
Yeah.
and when they, let's say they get approved and all of that, you don't actually go through that, you go through Hero or some other program?
No, so, you're gonna use the, I'm not doing that. Thought I was like changing the screen, but I'm gonna do it over here, sorry. Let me just switch windows here. All right, let me just write down kind of the general flow. All right, so you guys, we're all on the same page, I will do that this way. Anybody need any of this? Can't imagine. All right, so here's the process, right? Entry, rapport, inspection slash presentation. And then commitment, right? So you do all this stuff we talked about, and then you get your 10 out of 10 commitment, right? On a scale from 1 to 10, I'm ready to go. Right now, we're at the finance part. So you got the commitment. If you don't have this, does it matter what you get them approved on?
No.
You don't have a commitment from them, you have nothing. It doesn't matter what you run. I got you approved at 0% on 47 years. Okay. That's awesome, thank you. Right, now I know. Now I can go shop around. Now I can go see what else is out there. Alright? The commitment, that's everything. It's what you've been there for. Right? You don't have a deal, you can't help them, there's nothing going on until you have a commitment. So, right now, it's the, let me go to work for you, right? Or you. Let me go to work for you. Let me talk to my finance manager. Let me see what I can find out and do the best option available, right? So, once you have that commitment, you're gonna go to PACE portal. You'll know whether they're eligible on Hero or CalFirst or whatever on all the leagues, right? So all these different programs, when you get your appointment, it'll say Hero eligible, CalFirst eligible, PACE funding eligible, okay? So we do that check ahead of time. You should also get in the practice of using this. But in answer to your question, you're gonna start with a PACE program to show a payment. At a standard rate. Okay, this is through PACE funding. But if they're in a HERO eligible area, you're gonna get those low rates we talked about, 2.99 for the 5 and 10 year, 3.99 for a 15 year. They're lower than what PACE can offer even at a discounted rate, which we have available for them as well. It's just that their coverage is not as large as what HERO does. So it's the best for the customer most of the time, and they have more coverage. But you have an option, and this is not to confuse you, and I know it's confusing. You're gonna choose one of these programs for them. If you're in a PACE funding area and they want a 15-year term, you can stay with PACE funding right on it and switch the calculator to show them the lower rate. We have that available as well, okay? When we go through the portal, we'll get into that. Right now, I just wanna go through the process of, this is where you got to, now you're having a commitment, you're submitting an application. In the house, I said it earlier, I'm gonna say it again, you guys are brand new. Some of you are familiar with PACE portals, right? Which programs have you used? HERO?
HERO.
Have you used CalPERS for PACE funding?
I know, I've done a couple wide ranges.
Y-Greens,
but
okay.
maybe
So you've got some general familiarity with it, right? They're all pretty much the same,
Yeah.
right?
That's what I was gonna ask you, they align most of their requirements, right? Some of them, like if you didn't get approved for HERO, you might get approved for, but if you don't get approved for PACE, you're pretty much not gonna get approved for
Not
PACE.
true.
across the- No, okay.
But it's, I mean, I'm glad it's not that way, but, there's a lot of similarities. So each private lender has their own underwriting team, with their own underwriting internal, they're private lenders, so they have underwriting criterion. Some are more strict than others, some accept proof of income that the other company wouldn't accept as proof of income. So, some of them allow you to do, an appraisal to get an increased value, and some only use their automated valuation models, okay? So, when you're on the margin between approval and decline with one, we can probably, well, we'll check, okay? It's the best option for someone who is a poor credit customer, if they have equity, to find one of these programs that works for them. So sometimes it's a matter of, look, I'm not gonna tell these companies how to do their underwriting, right, but I'll give you a perfect example. The general guidelines I mentioned, right? 3 years property tax, no mortgage rates in the last 6 months, bankruptcy back 4 years, right? That's what everyone has right now. That's the general PACE guideline. Okay. We got a decline with HERO. Submitted to CalPERS, got an approval. Right? Do I wanna know why? I wanna know why HERO gave me a decline, and I'm calling them to find out why, hey, what's going on here? Why can't they get an approval? I'm calling my rep and saying, you need to go to work for me, I need this deal. Right? Call your underwriter, tell them to, figure something out. So I'm gonna do that up there, you don't need to do that, right? But that's what I'm doing if you get a decline, I am on the phone with my rep, or with the underwriter if I know them directly. Okay? In the meantime, you got a decline, the office is running CalPERS, or they're running HERO, or they're running PACE funding, or they're running E3, or they're running something. Okay? And once we get an approval, then we'll let you know, it's done. But you don't have to do any of that, see, that's the beauty of this. You can sit there with the customer and be like, listen, what's gonna happen next is, we're gonna come out to the house, our technician, and we're gonna introduce you to the project manager, we're gonna walk through the whole process, they're gonna let you know exactly what's gonna happen next, it's gonna take, complete care of you. You're gonna treat your house like it's their grandmother's house, and this is the next step. Boom, this is the process. So you can have a conversation, you can talk about baseball, I don't care. As long as you're building rapport and it's positive while you're waiting for a response, utilize that time. Do what I said first. Hey, we're submitting, let's get these pieces of information. Driver's license. We stopped there and then we had a question. So what else do you need? Driver's license is the first thing.
You would have asked for that before you submit the application, no, typically? Because you're gonna need that information to.
I would while I'm, look, so you gave me your commitment on 10 out of 10, I'll say, all right, great, so the finance company's gonna ask for a few things, just generally speaking, they always ask for different things, but here's what they always ask for. Let me get a copy of your driver's license, if you have that with you right now, that'd be great, start with that. Then while we're waiting for the approval, then we're not waiting for their decision, while we're waiting for the approval, right? Well, if you could get a copy of your most recent mortgage statement, and then if you have a paycheck stub, you know, or how, you know, I'm self-employed, 2 months bank statements or a bank statement, something that shows your proof of income, right? Those are the things you're gonna ask for while you're waiting.